Right, good afternoon, everybody. Welcome to our webinar today on JobKeeper updates and also a bit of a tax planning discussion for the 30 June. With the 30th of June coming up, we thought it'd be a timely reminder for a few of the things that we could look at before that, just in order to make sure our tax is minimised. So, look, we're not going to go into too much of an intro today. We've got a bit to cover off on. Suffice to say, we've been in JobKeeper now for a couple of months. We've done a few things. There's a few changes there, nothing too major. The government's done a few other little changes as well. So we'll talk about those. But yeah, really largely focusing on the tax planning side of it, given we've only got the 2 weeks left in a week and a bit left of the financial year. And then we'll run some questions at the end. So just going through a bit of housekeeping as we've done previously. If you lose the connection, it should be pretty straightforward to just refresh and commence the link again. A copy of the slides, notes, and session will be recording, and the recording will be available by Google Drive. And add your questions in the right-hand side there in the chat box. If you want to minimise the chat box as well, it just gives you there's a little bit of writing in some of this presentation, so it gives you that ability to make it a little bit bigger on your screen. And Brian and I are just going to minimise our heads on the screen as well while we're running through the presentation, and we'll come back for the Q&A. So if you have any questions, please put them in, and we'll try and answer them at the end.
Perfect.
All right. So we might do that now, Brian, if we'll just minimise ourselves.
Done.
What we're going to cover off, as I said before, what we're going to cover off on today is the updates on JobKeeper and other government assistance, 2020 tax planning, and then also we thought we'd do a little brief bit at the end on 2021 being the year ahead, given that the world doesn't end at the 30th of June. For accountants, it's a little bit like Christmas. We tend to build up to it, and then it sort of all slows down for a little bit, and it gets going again. So it's, but then obviously the next year ahead is going to be a key one to plan for, with government subsidies sort of finishing up in the first few months of that year, and depending on what's going on with COVID-19 and the general economy. So I thought we'd talk about that as well, and then we're going to have our Q&A session at the end. Okay, Tomo, do you want to take the JobKeeper updates?
Yeah, thanks, Joe. Afternoon, everybody, and welcome back. So with the JobKeeper updates, by now most people who are on that system have lodged 2 monthly declarations, and for those doing it themselves, I hope it's all going well for you. We've been doing a lot through our business, and people will start to see that we're shooting out emails each month to request the information that needs to go in. And the ATO are paying reasonably quickly, I would have thought, and doing a good job of getting that money back into people's accounts so they can use it. So that's good. Joe, you haven't seen any issues with people not getting paid at this stage?
No, typically what I'm finding is the earlier you lodge it, the quicker you get paid. Some of those that have lodged a little bit later, yeah, and the ATO have said that, but yeah, mostly pretty quickly, between sort of 5 and 7 days. Yeah, yep.
That's good. So just going back onto it, if you're not on JobKeeper but you're keeping an eye on it, just remember to keep testing or talking to us, because it's not as though you've missed out. If you become eligible in July or even in June, then that's when we're able to come onto the system. So all the way through to the end of September, keep looking at it and seeing if they're 30% down, and talk to us if you're not too sure how to work that out. And that, I'll stress, that's really important. There'd be a large number of clients who think they've done very well and not eligible for JobKeeper. When we go back and look at the data, actually finding out that they are, much to their own surprise. So don't just go off a gut feel. Talk to us. It's about the data. It doesn't lie to us. And if you can sneak onto JobKeeper, then it certainly helps out. What else have we got there? The government yet maintains it's in place until the end of September. Childcare is one of the things that they have changed, and I'm not hearing anything about anything else at this stage. Still more talk about the types of industry that may require further assistance come post-September, and that would be a lot more targeted. We have seen a little bit of activity starting to take place now on those that have engaged in fraudulent activity. That's probably been at the bigger end of town, Joe. Is that the ones you've seen?
Yeah, definitely. Yep.
So the ATO are trying to, I suppose, make an example to make sure people haven't made their way into the system that shouldn't. And I'm sure there's going to be a lot more activity in that area, not only in the months to come, but this could take 12, 18 months for them to continue to test into that. But I think they're really just trying to set an example at that point for the moment.
Absolutely, because and I have been very clear about that, and I think we were quite clear in our early webinars about JobKeeper that they're spending a lot of money on this as part of the program, and they want to be very careful about how that money's being spent and going to those that actually require and are eligible for it. They're also mindful that anytime they put something in place like this, there will be people that look to take advantage of it or to do things. So they are starting to follow through on that threat to check on it, and they will continue to do that.
Now, the ATO maintain that once you're in, you're in. So still talking to some clients that are a bit scared that they're getting back to normal or they're even better than where they were last year after becoming eligible for JobKeeper and concerned about that. Can only reiterate, once you pass the test and you're in for the course of JobKeeper up to the end of September. Even though we need to provide the turnover details each month, that's more just for information purposes for the ATO. So don't be concerned about that. Once you pass, you're in. All good. What you do need to do, though, is to make sure that your eligible employees are eligible each month. That's part of the declaration you're signing off on. So 90% of the time, that's all going to be fine. You're just making their $1,500 top up per fortnight if need be, making the payments by the due dates for each fortnight. It's the ones where somebody might go on to maternity leave, parental leave, or coming back workers' compensation. Those are the ones where it might change around a little bit that you just need to be aware of. So just keep an eye on that. If you do think you've made an error or something's gone the wrong way for you, just let us know. We can correct it immediately. The ATO has been very understanding when we're calling them during these times and very quick to be able to bring things back into place when we do make mistakes. So if that's the case and you think you have overclaimed, missed somebody, whatever it looks like, give us a call. That's what you're seeing at your end too, Joe, with the ATO?
Absolutely. I had an example during the week with a client who has accidentally or inadvertently claimed more than they should have in a company, became aware of it actually over the weekend and got a bit panicky and gave me a call and we discussed that. I called the ATO earlier in the week and spoke to them about that. They completely understood. They were fine with that. They basically just gave me the details to enable that client to repay the money back to them. Worth noting that you need to get that's nowhere on your business portal or anywhere. That's only available when you call the ATO at this stage. And the client paid that money back, and the ATO had stressed and actually thanked me and the client for specifically for coming back to them and sorting it out rather than doing that. So you're always in pretty well any circumstance with the ATO. Otherwise, if you find an error, you're always better to be on the front foot and go back to them, admit the mistake and correct it rather than wait for them to come and find it. So don't think it's going to go away. As we said, that's why we raised the point about them engaging in checking on these things. They will check on it. So assume they're going to look at you, and if you've made a mistake, that they'll find it. So if you've corrected it before, then you're going to be okay. It's a complicated system. They acknowledge that. They know there's going to be mistakes. So as long as we are on top of it, we're fine.
So all next right. One of the next things is free childcare is to stop at July the 12th, and that's really going to hit into the pockets of many people, including our Joe. So yeah, one of the things with the JobKeeper stopping in that sector was also the free childcare. So that will have a flow-on effect to many, many people. The cash flow boost is to apply to the June quarterly BAS and will have applied to the April and May if you're a monthly lodger. So the cash flow boost being the PAYG withholding that the government the ATO was covering off on, minimum of 10,000, maximum of 50 for the first quarter up to June, and then whatever you got in that June quarter, you got again from July through to September. So if you manage to get 50,000, if you're eligible for that, there'll be another 50 that's being paid in a number of ways. I've seen it via credits off the BAS, credits off your integrated account, all the way through to refunds of the total amount. That's what you're seeing as well, Joe, different ways that it's being applied in there.
Yeah, definitely. Yep.
But even seeing them go back and recredit some people that they'd missed out on or hadn't process those March BASs correctly originally. So, the ATO are all over that. The Victorian Business Support Fund for $10,000 grant, that's now closed and significant support's been provided there. I'm not sure that I've seen anybody not get that's applied for it now. The last I saw come through yesterday, actually. So that one's been really good since they did open it up to what we call Stream 2. So those that were just eligible for JobKeeper and met the other eligibility criteria. And banks are actually starting to lend money for support. And Joe, I think you said you've got some examples where you're seeing that come through now.
Yeah, so we're a fair way down the track. I think we said initially we would be thinking that at minimum the banks, we wouldn't be seeing anything starting to happen until the 31st of May, and that's been quite true. It's been quite accurate. It's taken quite some time, but now the banks have got themselves in order. They've been able to start to process some applications, and I'm starting to see some funds flow, both in terms of the small business, the one linked to the grant, the 250, but also just general extensions of finance facilities, that sort of things to help to assist clients through this. So I suppose my feedback from what I'm seeing with the banks is that they are getting a lot more organised and on top of this stuff now, which is good, because it means people are able to get money quicker. And thankfully, those people that I've known that have been clients that are dealing with the banks have been able to survive until they've been able to get the application through. So, which has all been very good, but it has taken quite some time, unfortunately. Yeah. We knew it was going to, and we've been able to work through there until then. So the other thing, there's some other things that have come out. We're not going to go into too much detail on this one, but it's a 25k home builder grant. This one came out last week, I think it was. So it's basically $25,000, and it's for renovations or new homes over a certain amount and under a certain amount. There's requirements around income levels for individuals or couples, and requirements around having to enter into a building contract and start. It's an interesting one. I've had a few people ask me about it. I think it's one of those things, if you were going to look at, it's really great timing for those that were looking at building a house anyway at this point in time, because it just means they're getting an extra $25,000 or a reduction of 25 off what it's going to cost them. I think what it's going to do is put a lot of builders under pressure, and people that operate in this industry, given the timeframes we're talking about here. So we've seen this sort of thing happen in the past with timeframes, and what it means is there's going to be a lot of contracts signed. There's going to be a lot of work commenced, and there's probably going to be a lot of building work on the go, which is good, but it's going to be a bit of a challenge. I think probably going to filter down to those management within those building companies to make sure they can keep on top of timeframes for getting those houses and renovations done, because the demand's certainly going to be there. It's certainly done its from what I'm seeing within my client base, it's done its job as piquing interest. As I said, it's good luck for those that were going to do it anyway. Are you saying anything about this, Brian?
No, most definitely. Same thing that you're talking about there, Joe. Through from talking to builders, to real estate agents, to finance brokers, all very much fielding huge expressions of interest in relation to this. So it's hopefully going to do what it's designed to do and kick off in that building trade, which just has a huge flow and effect, which would be awesome at keeping a lot of people in work in that section of the industry. For
sure, absolutely. So that's there again. If it's the sort of thing, if you're going to do it, you're going to do it anyway. Great, and it may well actually, I suppose, bring some renovations or new homes forward for those that were looking at doing it past like into next year, which is the whole purpose of it, of course, is to bring the work in now and get it going. We'll see more about that as we go through. Moving into tax planning. The key things we're going to cover off on superannuation and new assets, because there's a little bit more in those areas, a bit more complexity. And then we've got some other considerations that we're going to discuss as well. More than happy to take take questions or things about other things. We can't cover every single tax planning strategy in this session. So if you have questions about any that we don't cover, please put them in there, and we'll cover them at the end. So to begin with, superannuation. Before we get there, what is tax planning? Why are we doing this? So tax planning is all about bringing expenses forward where possible. So we're trying to bring expenses into the current financial year, which reduces our profit, pushing income back where possible. So again, we push income into the next financial year, which reduces our taxable income. And then considering what will happen in future years to understand the degree in which you should do the above. That's a crucial element of this. Sometimes there's circumstances where you're actually better not to bring expenses forward or push income back. An example might be where where your business is growing and your profit's actually going to, or you're confident your profit's going to increase next year. It may not be a good idea to put more income into next year. In fact, it's probably not a good idea to do that. So it's just looking forward. It's not just looking at the next 12 days and the year that we've had to now and just looking at that in isolation. It's looking, okay, well, what have we got coming up in the next 1 to 2 years, or further if we can go out that far, and how do we minimize our tax liability this year, keeping in mind what's going to happen in the future. So it's a little bit of crystal ball gazing, the combination of managing our tax liability over that time.
And just to reiterate on that, Joe, I think a lot of people tend to start into that tax planning area and then all of a sudden start to gauge their whole success for the past 12 months over how much tax they can save in these last couple of weeks. And start to lose sight on the whole thing, when really it's all about putting yourself in the best position, both financially and strategically, to maximize profits going into the future. So tax planning is just about saving cash in order to assist you in that next 12 months to achieve the goals that you really set out to do. So it's really, at the end of the day, no different than comparing your power bills and saying, can I be paying less somewhere else and conserving cash? So it's just getting yourself into that best position. So please don't lose sight over tax planning being the only goal for the year.
Absolutely, I think that's a great analogy and a great point, Brian. Is that we're not in here. We're here to minimise tax, but we're here to maximise your financial outcomes, and it's not about getting our tax bill from whatever it is down to zero every single year. Because if we're doing that, we're probably losing sight of where we're going in the future strategically and what we're trying to actually get out of this. So the end goal is it should never start with how much tax can I save. It's just a throughput. Great. So just, I suppose, keep that in mind as we step through this. So superannuation for the self-employed, just keeping in mind our concessional cap for 2020 financial year is 25,000. What is a concessional cap? It's basically the amount we can put into superannuation and claim a tax deduction for. Anything more than that is what's called non-concessional, which makes sense, and that's a bit that's you're not claiming a tax deduction for. So the difference in the fund is that if we put concessional amounts in and we claim a tax deduction outside, we get taxed at 15% in our super fund, whether that be self-managed or otherwise. If we put non-concessional contributions in, so essentially we're just transferring money into super and not claiming any tax deduction, we don't pay any tax on that amount of money in the super fund. That's just a one to the other. Now, this is the first year. Before I go into that $25,000 also includes your employer contribution. So your superannuation guarantee charge on your wages, that comes into that $25,000. So if you're being paid for $100,000 and your super is $9,500 on that amount, your concessional cap or the extra amount you can put in concessionally is $25,000 minus your $9,500. So $14,500. Anything over and above that, you're really just contributing to get more money into super. There's no tax benefit to do that. Now, having said that, this is the first year of being able to roll concessional caps from the prior year. So previously, if you didn't use your 25,000 or whatever the cap was in that year, it was gone, and you just you move into next year and your cap starts again. Now you're able to actually roll that year to year, and this is the first year we've been able to do that. So if you didn't have any concessional contributions last year, it essentially means that you can put in $50,000 and get tax benefit for it this year, and so on and so forth. That will roll forward if you don't use that concessional cap. So, which is really useful for a tax planning purpose. When we talk about before, I actually used this with a client recently when we knew that they'd have a CGT event, a capital gains event this year, versus last year they didn't have any capital gains events. So we actually didn't put any money into super last year and maximised it this year, so that we could get that 50 in as opposed to 25 and 25, which is a better outcome. So that's the sort of thing where we can look ahead and start to plan forward as to when we should be putting money into super. Pay to the fund as soon as possible to ensure they receive and process before 30 June 2020. So we don't want to be paying that. In fact, the next slide has a point about employee super and when we need to pay that by, particularly for using a clearinghouse. But we don't want to be paying it on the 30th of June, particularly if we're paying it to an industry or other non-self-managed fund, because that's the likelihood of that being received on that date and all processed is a lot slimmer than if we pay it in the next week or so. So just keep that in mind. Have you got anything further to add on the self-employed bit before we move to the employee bit, Brian?
No, you've covered that one off, Joe. That's perfect.
Cool. So our employee super must be paid in this financial year to be able to claim. So we can only claim superannuation expense that we actually physically pay. So if we want to claim a tax deduction for the June quarter super, if you pay quarterly, we need to pay that by the 23rd of June, particularly if we're using an ATO clearinghouse. The ATO that's an ATO nominated date. That's not something we've just said that's 7 days before. That's an ATO date that they've said that needs to happen by that point in time in order to guarantee it being cleared through before the 30th of June. I've just said there that we complete a reconciliation or it would be a good idea to complete a reconciliation while you're doing that to ensure that all super liability has been paid for the 2020 financial year. Obviously, we go through and we pay that. Some businesses pay it monthly, some businesses pay it quarterly, but we just want to make sure that we've actually physically paid all of our super for that financial year. And it's a good time. You should obviously double check before you do it on a quarterly basis, but it's a good time to do an annual one and just make sure that that's happened. There is a superannuation amnesty that's in place at the moment, which is for unpaid super prior to 31 March 2018. So there are businesses out there that have had issues in the past and haven't been able to pay super or have paid it late. There's the ability to, before the 7th of September 2020, put your hand up and say, look, I haven't paid this, or I paid it later, or I've had issues before that date. And the ATO has been very generous in the benefits around doing that, in that there's reduced fines and penalties, as well as the fact that the big double whammy with not paying superannuation time is you actually don't get to claim a tax deduction for it when it's paid late. So what the ATO has said is if you do this and you get it tidied up before the date, or you get into an arrangement with us before that date, you will be able to claim a tax deduction for the super. So it's an enormous benefit. So for anyone that is in that position, we've been speaking to people about that. But anyone that's in that position that's interested in knowing more about that, please let us know, because it's a very generous thing to take advantage of, and we'd recommend you look at it wholeheartedly if it applies to you. I think that's about it on that, Brian.
Yeah, all I'd add on to that one, Joe, is for those in business out there employing people, this is probably the very first tax planning measure that you should just do, is paying that super by the 23rd of June. It's an expense that has to be paid in July anyway, so bringing it forward and claiming it as a tax deduction just makes complete sense when you're looking for tax planning ideas. So please get that paid as soon as possible if you're looking for that deduction.
Definitely. All right. Oh, sorry.
So
there we go.
That takes us over to the instant asset write-off of the 150,000 for businesses that are turning over less than 500 million. That was originally to 30th of June 2020. That's now been extended to 31st of December 2020, which is fantastic. So that's the one where we can claim the new or second-hand purchases up to 150,000 immediately as a deduction. So just be mindful though, with motor vehicles and things like that, there are depreciation cost limits in place. So it needs to be a commercial motor vehicle. Certain definitions of that is it's got to be a 1 ton, other type things as far as getting into that. So if you're chasing some of those vehicle deductions, just make sure that you check with us that it's going to be eligible. Otherwise, you could be spending 100 or so thousand and only be able to claim about 57,000. And we don't want to get caught in that position. Also got the backing business investment, which is that started on the 12th of March 2020, and that runs through to 30th of June 2021, and that's for new assets only, and it's not depreciated under any other rules. So it's quite complicated in here, but originally they were just talking about claiming 50% of it upfront of that asset, and the balance would depreciate at applicable rates. So that's for what we call non-small business entities. So that's in the turnovers that are up pretty high. Majority of our clients come under the small business entity rules. So we get to claim 57.5% deduction in that first year, and then the balance depreciated at applicable rates after that. So that's up to that limit of 500,000. So that means rather large assets can be purchased there, but got to be brand new. So it could be headers, all those sorts of things that normally wouldn't fit into our normal instant asset write-off rules. And I think post 31st of December 2020, Joe can correct me, our limits fall back to $1,000.
Yeah, that's my understanding. That was what was slated to happen at the 1st of July before they moved that. So I'm assuming that would be the case. They've just moved the date back to the 31st of December. So yeah, I think back to $1,000.
Yep.
Yep.
And the other thing to take note of with both of those is we need to purchase the asset and have it available or installed ready for use in order to claim it. So you don't have to have used it, but it has to be available and installed ready to go. Anything else on that, Joe?
No, I think that's about it, Brian. We did miss having that $500,000 amount there, so thanks for clarifying that for the backing business investment. Essentially, very generous rules. The other thing to keep in mind here that's interesting, we have some option. We don't have to decide this before the 30th of June, but what this has done inadvertently is that, and we discussed this in the internal training we had a little while ago, was that the $150,000 instant asset level for small business entities. Typically, what happens is if your pool ends up under the instant asset limit for the year, that pool is written off completely. Now, typically, that up until recently, that's been $30,000. So it's been significant, but it's not an enormous amount. Now, what this actually means is that if your general pool, which is what we call where we put all your values of your assets when you're a small business entity, so all your assets combined and then written down, if that balance falls under $150,000 this year, that will be written off completely in the year. So so basically removes any depreciation on those assets going forward because it's all coming into this year, which is quite substantial. We do have the choice too of for any new assets potentially looking at not going into that system. So if we don't need that deduction for some assets and we want to depreciate them on normal rates, we can actually look to do that as well. It just limits our ability to go back into pooling for a period of time. So that's something we'll be looking at after the 30th of June when we have a look at this, but it's obviously something we're keeping in mind with clients is that if their pool balance falls under that level, that's going to be a significant depreciation expense in this current financial year without even doing anything, without even meaning to do anything. So I'm just keeping that in mind. So just on that will obviously help your tax this year. But what it does is it actually hinders your tax in future years because you don't have, instead of evenly writing off that 150 over a period of years or at a diminishing value, it's all gone. So it will help significantly this year. We just need to keep in mind that we won't have that there in future years to help us.
And I think if we wrap all that up, Joe, it just means that we'll be talking to you a lot more about that subject at the time we go to do your tax this year. So because for some, it's turning a negative result for them instead of getting them where they need to. So it's actually going to require more planning, which we won't bore you with the accounting details of now, but expect to hear a little bit more about that at a later time.
Absolutely. Now, this is something I'm pretty passionate. Well, we're all pretty passionate about, but it's something I get a bit on the high horse about this time of year because it's frustrating to see. So I said to Brian and Amy when we were doing this presentation, I want to put a slide in about this because it drives me insane every year. Please don't throw away good money. This links into that whole thing about what we're trying to achieve with tax planning, which Brian explained so well earlier. Is that we're not trying to completely wipe out tax, we're trying to manage tax. So cannot be clearer here, do not purchase anything for tax planning for the sake of saving tax. So do not purchase anything unless you were going to do it anyway, and unless it makes commercial sense on its own. That's always the kicker. I had an example recently where a client just told me they're going to go and buy a tractor or some other bit of machinery. I said, well, do you need the thing? I actually said, well, why are you buying that? And they said, well, I don't want to pay tax. I said, well, but you're going to spend $100,000 on this bit of machinery here, and you've got you're paying largely cash for that. Or if you fund it, you've got to pay it back, pay the loan back, and you're not going to use it. And you're doing all that to save 30% of what you're going to spend in the first place. So tax is only ever a secondary consideration. It's not an initial consideration. We don't do anything because of tax saving. And you're always better to keep the $100 and pay $30 in tax than to spend $100 and save $30 in tax. So I just wanted to. Do you have anything to add there, Brian? After I've had my little rant.
No, I agree completely, Joe. And this is very difficult because I think we're conditioned to this ever since we're all very young children, listening to normally our parents or somebody else saying everything's about saving tax and doing things to save tax. So to go against that is against the grain of what comes naturally just about for us at the moment. But you only want to spend money on things that are actually most likely going to cause a higher tax bill later down the track because they're making you more money. And that's the way you want to look at it. It's about the commercial aspect of it. So don't throw away the money just for the tax planning purposes. And I suppose one of those quotes is, wealth's not about the tax you save, but it's about what you keep. So let's make sure we keep more and only worry about what we've got left, not about how we got there.
Yep. I like that. This is even more of a, coming back to the whole scenario that we find ourselves in at the moment with COVID-19 and the uncertainty that some of us are experiencing, some more than others. The expression "cash is king" is something I've been talking about a lot with clients at the moment, and more now than ever, because the ability to have cash available now, or the ability to use cash, either as a buffer or to take advantage of opportunities. Now is the time you want cash. So don't be chucking it away.
Done.
All right. Now that we've got through that, other tax considerations. You want to do this one, Brian?
Yeah, so we'll kick off there with bad debts. So this is where the time of year where you go through your debtors list. So people who owe you money, and start to work out whether there's really some on there that you're just not going to collect. So in order to be able to claim them as a tax deduction, if you're on the accruals basis of tax and you've actually brought them in as income, we need to officially take them back out as a bad debt. So to do that, you need to make sure that you've actually written it off. It's not collectible anymore. Just go through that list because there's nothing worse than having $10,000 or $20,000 worth of debtors on your list at this time of year that you just don't look at, and you're not going to collect, and you will pay tax on that. So don't get caught with that one. Go through your list.
So just on that one, just be mindful too that in order to be able to claim a tax deduction for that, you do have to have genuinely, chase them. You want to have documentation that says, that I've chased them, that there's no response, we're not getting anywhere. Essentially it needs to be a genuine bad debt. So that you need to have tried to recover it and be able to document that, and not being able to do that in order to claim
Go for that one. Next one, Joe.
All right, so prepaying expenses. Do you have expenses that would ordinarily fall this year? That should read fall next year that you could pay this year. So again, there may be some reason to, you may have had a higher income year this year, and we have a need to bring some expenses back into this year. So we've got the ability to prepay some expenses, particularly as a small business entity. As long as they fall within the next 12 months, they would have fallen within the next 12 months, you can prepay them and claim them in this year. So that may be something we look to do. Conversely, the other side to that, which I may as well continue with, is delaying income. So if your cash flow allows for it, can you push out billing income or invoicing into July as opposed to June? And again, that's only relevant if we want to move income back into next year. If we're going to have, we think we're going to have a bigger year next year, well, it may be worthwhile trying to bill as much as you can this year and get it done. So that it's either for those ones. Do you want to keep going there, Brian, with completing a stock take?
Yep. So for businesses that do have closing stock or stock, then you're supposed to have a stock take done at the end of the financial year. There are some exemptions to that for small business, and if it doesn't move by $5,000 odd, but for most, you need to do a stock take. So it's really going through that and saying, well, is there obsolete stock in there that can be written off? Even if you're not doing this for tax purpose, really important. Many people can carry stock for years and years on end that just needs to be somehow either written off or actually sold in some way, shape or form, because it's just cash sitting there on your shelves in a warehouse doing that sort of thing. So take some note of that and make sure you write off those things that might be just sitting on a bit of paper as a number, but it's absolutely worthless to you. Moving on from that one, Joe, I think completing a review of depreciable assets. This probably more relates to those that probably aren't under pooling, because pooling probably takes care of most of those assets. But if you're outside of pooling and because it is a choice to be on that, then there could be assets sitting on your list that have a written down value that could be scrapped if they're actually of no value to you whatsoever. That could be a piece of machinery sitting there for $15,000 and just depreciating a bit by bit. But if that machine is absolutely a no-go anymore, then that can be written off completely and assist with the tax planning side of things there.
Yep. Excellent. So moving on, valuation of closing stock. We've got a bit of a variety of methods we can use to value that, and we can value different lines using different methods. So keeping that in mind, and that's really just looking at it to just select one best, and it links obviously back into that stock take. So we need to know what that number is before we decide how we value it. But we do have some options available to us there. Bonuses paid when incurred and committed to. They can be paid later, but need to be committed to prior to 30 June 2020. So you can't just sort of say you're going to pay a bonus and then not pay it just to get a deduction in this year. Ideally, you pay it or you accrue it, and it's got to be paid within a reasonable time period into the next financial year in order to be tax deductible this year. Negatively geared properties. Perhaps prepaying interest. So this is a little bit less uncommon, but it's still there as an option. Prepaying some interest or other expenses, utilising some depreciation where that's available to you for those properties. So for individuals, there's the ability to, again, if you've had a year where you've earned more, you've received a bonus, or you've done something like that, and your income's higher, perhaps it might be worthwhile having a look at pushing some income back or bringing some expenses forward from the next year in order to keep your taxable income as level as you possibly can, because that's the ideal one. You want to keep going through there, Brian?
Yeah, then vehicle logbooks. Note just to make sure you've got them updated to substantiate your claims. Many people don't have logbooks at all, but in order to claim a business use percentage of whatever the vehicle is generally in our businesses, we need to have a logbook once every 5 years. It needs to be kept for a period of 12 weeks and be indicative of what your usage of that vehicle would be. Don't need to get a new logbook if you change vehicles. It's more about the use of the vehicle, but very important to have one in place is the ATO, and they do quite often look in these areas for motor vehicle deductions because they know from their end it's probably an easy take in an audit to be able to put in some fines and penalties, because if you don't have that logbook, they can be very difficult with the way they do things and just almost be private use for the whole vehicle. And that means all the costs associated with it as well. So just make sure you've got those things in place.
I think Brian, you and I and our business partners and colleagues have all been through audits in the past where just take it from us, a vehicle logbook can save a lot of pain, a lot of pain, because it's, yeah, as you say, they get pretty violent on that area, don't they? It's yeah.
Most definitely. And same thing, we're in the midst of doing our own little logbooks this year because it's been 5 years, and as much as the filling in of those pages is a real pain in the backside, I do think about the fines and penalties clients have paid. So it certainly helps me fill in that bit of paper.
Yeah, absolutely.
Then moving, we've got income protection premiums. So those are tax deductible for an income protection. So not life insurance, but income protection. Those premiums are tax deductible and worth considering if you don't already have cover in place. And at this time of year, you can actually, I suppose, pay your premium in an annual premium. So I'd be claiming the next 12 months versus paying it in a monthly one. So if you are considering income protection and you're looking for the tax deduction, then doing that now and having it in place before 30th of June, you get to claim the full amount of that premium. Capital gains event planning, small business concessions. Do you have gains that have rolled over from prior years that need to be dealt with? So in the past, some concessions that we do have capital gains, we roll them over and we normally have, say, 2 years to deal with them or do something with them. They may already be attached to what we call other assets, and we even sell that asset, which means the gain crystallizes again. So we just need to be mindful of those things because we can forget about them very quickly. But if you are aware of ones that need to be dealt with, then there's different things that need to be done before the end of the financial year for those ones. You got anything else on that one, Joe?
Oh, just probably more. So there's the small business ones, which we've mentioned in there, but there's also just be mindful that if you sell property or do anything like that where it's a significant transaction during the year, just talk to us about it, even if you think it's not going to be relevant, because quite often we find people getting caught out or being caught unawares with things that they think we don't need to know about necessarily, but there's implications of things that could have been corrected in that period of time. So it's always a good idea if you sell a house or you sell a property or sell a business, or business obviously we'd probably know about, but some of those things that we may not know about, that you keep in touch with us to let us know, because you can plan around that. There's some options and there's some things we can do, but once we get past the 30th of June, quite often those options are very limited. So just keep in touch.
And sometimes with the capital gains, you could have some gains, but you might have some other assets that if you sold them, they might incur some capital losses, which helps offset those gains. So it's worth considering your whole position and looking whether it's worthwhile selling some things that you may have invested in. Probably shares is more what I'm referring to, because easily bought and sold, but there might be some that have some high losses involved, especially with the downturns that we've had. And that could help reduce CGT overall. So just have a look at your position.
Yep, absolutely. All right. 2021 looking forward. So that probably covers off the tax planning side. So 2021 looking forward. So we're talking about 2021 financial year, obviously. We're not quite at 2021, but great time to review your strategy for the year ahead. Now, in the financial year, we need to do full results, obviously full financial results, and prepare them for our tax. So it's a good time to have a look at that. We don't want to wait necessarily for all those to be completed for a compliance point of view to be looking at our results. We should be looking at them as soon as we can after the 30th of June, and in fact, regularly during the year. But it's a great time to review the strategy for the year ahead, to look at it in terms of, okay, the next financial year, what are we looking at? It's easy to measure when we get to the end of financial year because we know we've got results that we can look at for sure. And so it's a great time to sit down and have a look at that. But at this time of the year and also in January, if you're looking at wanting to look at a strategy, that's a time to be doing it, I think. Completing forecasts and pressure testing. So looking at what you think might happen. This is particularly relevant this year for a lot of businesses, but what might happen in the next 3 to 4 months, 6 months, 12 months, and then sitting down and pressure testing that with either your business partner, key staff members, or all staff members, if applicable, and getting us to have a look at some of that with you as well, just to make sure that you're considering all the options there. So pressure testing is not about just trying to break it. It's also about trying to identify opportunities as well within the business. So it's certainly something we love doing with clients, and preparing for when government assistance ends post September 2020. So there's been a bit of discussion about this. JobKeeper finishes in September 2020. The last payment will be in October at this stage, pending, as far as we know. That's all we can operate on. And we know that Job Seeker is going to finish around that time as well. We know Cash Flow Boost is going to stop after that. That'll stop being a benefit up to that point in time. So all of those things have helped businesses and probably cushion the blow to a degree, which is the whole point of having them there in the first place. But what we don't want to do is obviously fall into the trap of when they stop completely, which is, again, some of them may be changed and gradually weaned off, but it looks like at this point in time they're going to stop and go back to very minimal or nothing. We need to be mindful of that and what we're going to do at that point in time, because the assistance has been quite significant for a lot of businesses. So that not being there anymore can put a real hole in things, and it's a bit like falling off a cliff when we get to that point in time if we haven't thought about that. So we thought we'd just put that there, because we're more than happy, and we in fact understand that we will be talking to a lot of clients about that over the next few months, because it's important to consider it.
Exactly, Jack. This is actually where tax planning starts for next financial year, and the tax planning is as a result of sitting down and completing our own forecasts that we've got listed there. So it's really taking responsibility for our direction ourselves and being proactive about where it is we want to be and where we want to get to, versus being reactive to the market and the forces of what's going on around us. So when we sit down and complete those forecasts to achieve what it is we want to achieve, which means we want to earn the money we want to earn, to spend where we want to spend, then we're really starting to take control of it. And that's exactly what we do in our business. And we spend 2 or 3 days together. It's that important, this part of it, of really nailing down where it is we want to be and what we want to do. And then that just helps with our decision making on the way through. So when we look at that, we then know what our profitability looks like, which then means we start looking at the tax aspect of it to say, is there things we could do that actually will minimize our tax by doing it slightly different, or what strategies do we put in play to actually take care of that? And that takes a real lot of pressure off trying to do tax planning now, because we've actually done it 10 months in advance. And we just then follow that plan for the rest of the year.
Yep, and it gives us a roadmap, doesn't it, to refer back to all the time. And obviously it's not set. Things change. We should all be more than aware of that this year. Things change, things come up that we're not predicting. But at the end of the day, if you've thought about it and you've got that roadmap there, it makes the decision-making process of working through it a lot easier.
It's trying to control what we can control as much as we can, and being prepared for all the other outcomes that might come our way.
Absolutely. All right. Do we have any questions? Oh, yep, we have questions. Great. We did have one prior to the session, so I might just deal with that first, which is from Lisa. Sorry, yep, we'll put our heads back on the screen.
Okay.
Lisa, thank you for your question which came up before the webinar. Do June super payments need to be paid by the 23rd of June 2020? I think we covered that off a little bit in the bit about super. Ideally, yes. The ATO have said if you're using their clearinghouse, yes, that's the date. But if you can be aiming for any super contributions by that date, that would be sensational, because that gives it 7 days. Really, there's no reason why a fund couldn't accept it in that period of time, particularly if you're paying it electronically. So I think if we aim for that 23rd, which I think, looking at the looking at the dates, is, where are we? 23rd is next Tuesday. That would be ideal. Having said that, look, I think most funds, if you're paying electronically and those sort of things, are not using the clearinghouse. If we just aim by the end of next week, I would have thought would be ample. Yeah, sooner the better. Sooner the better.
Exactly. Last thing you want to do is miss that 30th of June where the fund's declaring it at their end.
All right, we've got a comment here from Brenton. Thank you, Brenton. Man after my own heart here. Reinstant asset write-off. Need a return on your investment to make the purchase worthwhile. Crunch the numbers before purchasing. Absolutely, couldn't agree more. That's the before you purchase. Well, any investment in an asset, whether it be a depreciating asset using in your business or buying shares, property, whatever it is, that's an investment. Doesn't matter. You're using cash to buy something else, or you're leveraging to buy something. So there needs to be a commercial reason to do that. Or some purchases, obviously cars and otherwise, there's not always an absolute commercial decision, but we understand why we're doing what we're doing. And again, I think your point is valid. And as I can't remember the quote Brian you used before, but at the end of the day, it's about growing our wealth, not saving tax. It's good comments and agree entirely. Do you have anything you want to add to that, Brian?
No, I think you've covered that one, Joe.
Excellent.
Pretty sure everybody knows where we sit with that one there.
Good. Okay. Nerida, thank you for your question. Do you need to do logbooks for Hilux vehicles in a small business fleet? Brian, I might check that one to you. Your thoughts?
Yeah, thank you for that, Joe. Awesome. Yes, Nerida, the logbooks and Hilux vehicles, it comes back to the definition of whether that Hilux is going to fit into, I suppose, the 1 ton type definition, commercial vehicles. But even within that, it then needs to have hardly any private use whatsoever. It's part of the eligibility there is the minimum private use for that motor vehicle. So even just driving to home to work is about the limit of the private use that you're able to do. If it goes anywhere else, then they're basically going to say you just fall back into normal logbook considerations. So unless you can pretty much guarantee that your employees or staff team that are using those vehicles are signing off that is all it gets used for and it's not going to the footy on the weekends and doing other things, then I would suggest you get some logbooks done just to be safe. It's seen too many tens of thousands of dollars in back taxes and fines paid to go without having those logbooks in place. Yep,
couldn't agree more. I wouldn't change any of that. Perfect. Great.
Oh, Brenton's pointing out that you can get logbook apps on your phone that you can use. So yeah, I think there's a number of different apps and so forth out there to help with your tracking of it. And I think from that, a lot of those ones are actually almost live data and physically tracking you via GPS. So if you do go down that track, then they're really understanding where you're driving and how you're doing it.
Which is good.
Puts it all in place.
Now, Lisa, where are we here? Sorry to go back to the super question. I have casual staff. Do we pay the super they have accrued until 23rd of June or estimate to 30th of June and rectify in July? Okay, so you're saying you're not sure of what their superannuation potentially is going to be or if there's going to be any for that extra period of time. I would tend to pay what you know up to the 23rd of June and then to correct the balance. It should be minimal anyway for that last week in July and sort that out then. Rather than trying to estimate, pay it in full and then correct it again. That's going to be very difficult. So pay what you know.
As I think part of the problem with that is if you overpay, technically you're not able to underpay them next time around because you've got to actually meet the right criteria in the next quarter or the next month. So I would only pay for what you know to and rectify the rest in July. Yep.
Excellent. All right. Well, I think that's all the questions we've got to now. Thank you to everyone who's attended. Thanks, Brian, for your expertise and your time as always. It's been very good.
You're welcome, Joe. Thanks, Amy.
And Amy.
Thanks for everybody else.
So now we are going to continue to run webinars. Not going to be as regularly as we have been. Obviously, the JobKeeper, that was every week, but we're moving them out. We're going to do them quarterly, and we're going to do them on topics. We have already sought some feedback and received some feedback from people about things they want to hear about, and so we will be covering some of those things off in those webinars, in the future webinars. We're also going to send out, and Amy may have already done that, but we're going to send out some feedback forms for you to, or some very brief feedback as to things you want to hear about, so that we can do that. We want to do these things for things that are just interesting to you, and that you're going to get value from, not just because we want to talk about a certain topic. So, and we've already spoken to people. We've got the ability to get third parties obviously on board around things like property, staff management, wealth management, all those sort of things. So the plan is to actually get third parties, so you're not getting sick of Brian and my heads and answers and voices. We'll get some other thoughts and specialty advice from people that operate in that space. So please give us your feedback and tell us what you want to hear about, because we'll organise that. And please also, if you can, there'll be an option there to put your name in there. Amy may just touch base with you to just get some clarity around what you're particularly wanting in that area. And I think she was also going to add an area where you can put some notes in there. So the more detail you give us, the better, because we're then in the ability to, in the space, to be able to create that, make sure we're tailoring it to what you're looking for.
And that's really important, because what we find is generally those questions and queries that pop up into people's mind, it's pretty common across everybody, and everybody's learning from just listening to other questions get answered, even seeing some things that they don't know what they don't know, and it's very important. And we just find that this medium just allows so many more people in to share at the same time and learn and take better control of their business and make better decisions as a result. So if you can pop as much detail in as possible, that means that we can really try and nail what those questions are and come back.
Absolutely. Happy end of financial year. We're here. We've now managed. I think Amy's put the link in the feedback in the comment section there if you want to go there. Amy, I think we're going to send something out via email as well. So if that already hasn't happened, we might do that just to get some feedback. Thank you very much again for your attendance. If you have any questions in the meantime, in the next little while, please give us a call. Happy to talk as always. Thanks, Brian.
Thanks, everybody. See you later.